Hi, guys, and welcome to the 33rd episode of the weekly trading wrap up, where we talk about the weekend markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. As usual, we're starting with the picture of the S&P 500. Happy 4th of July, everyone. This is a shortened 4th of July week. This arrow denotes Monday, Tuesday, Wednesday, and Thursday. Almost a carbon copy of last week. We have a melt up type of move, slow grind up. Um, Euphoria, as we mentioned before on Twitter, for the past week, I was expecting this market to drift higher into the end of the half of the year, uh, and all the way up into 4th of July weekend. Okay, and that's exactly what we got, a little constant bid into the market for the past 2 weeks. Okay, so let's begin by starting with the technical picture. Okay, what do we see technically speaking? Let's take out the arrow, we don't need it. Let's put on the moving averages. We finally got the 50-day moving average in red and the 200-day in blue. We finally got the what would you call it, golden cross, when the 50 crosses above the 200. Upward sloping 200. All this is very, very bullish. There's nothing more that can be said. We hit all-time highs, so this is very, very bullish. As I said before, my preferred scenario, getting into the summer doldrums, which we will get into after the 4th of July, is a sideways market. We didn't get that. We're getting a bullish market. Now, that was the bullish market. The bullish scenario was the second most likely that was going to happen. And we needed some kind of catalyst, probably lower rates going forward. However, technically speaking, we have a golden cross, we have bullishness, we have all-time highs. This is technically a bullish scenario, okay? And we should look at it in this case. However, with the summer doldrums coming in, I'm expecting a little bit of a correction coming in. What kind of correction? Because, I mean, we're getting into halcyon territory. That's why. But it won't be a big one. I mean, we might come back down, retest the highs at 600 maybe touch the 50 because we're getting really extended above the 50. So I'm expecting this market to pull back fairly soon. Okay, and because of that, I have about 2% short exposure. Added a little bit more on Friday on something, but basically, very little short exposure going in to next week. Because although I am net long, I'm not saying go short. Don't go short, it's stupid. But you should have at this point some short exposure because this is getting a little bit extended. And, that's not the only thing that's saying it's extended. I mean, when we look at the technicals, we don't just look at the candlestick chart, we also look at sentiment. So what does sentiment say? What does the fear and greed index say? Well, finally, we're into extreme greed. So that you should be cautious, okay? Everything is telling us extreme greed. We just started, so it could last a little bit longer. I don't know. You never know how long these can last. It's not a timing indicator, but it's telling you that we're getting into extreme territory. A lot of calls are being bought. The put-call ratio is at very, very low levels. Market volatility is still pretty low. That's very, very low. Everything else is at extreme greed, and here this should be extreme greed. I think it's delayed. I think every indicator, stock price strength, stock price breadth, and the sentiment indicators are saying extreme territory to me. Okay, but what about the AAII sentiment indicator? We always look at that too. Finally, after weeks of barely nothing, we finally get very bullish sentiment kicking in. However, it's still average bearishness. We're not like down to like 19 or 20 bearishness. So we are very, very bullish still. Okay, so the sentiment finally started to turn bullish in this AAII and is getting an extreme bullishness, extreme greed in the fear and greed index. So that's why you should proceed with caution. That's why I think after this exhaustive move up, we're going to get some kind of correction. Again, I don't think it kills this market. but I'm just positioned to profit from it as it goes down. Again, it's just a mathematics thing. If the market goes down 5%, which is normal, I mean, that's a 30-point move. You're back down to 600, okay? A 5% move in the market, my puts should make me 3 to 5x. So if the puts are 2% of my portfolio, I should make that 5% at least as the market goes down. So I shouldn't lose as the market goes down. And if it continues to go up, great, I'll profit from my long positions. That's why right now it behooves you to have some short exposure. We've had some short exposure since here, a little bit early, but the point is you should have it for the whole summer. I have a series of puts and other strategies expiring in July and August. So I think I'm well positioned to ride out a possible brief downturn in the market coming up, especially considering how far stretched we are from the 50-day and the 200. Okay, so that is the technical picture and the picture of what I expect to happen in the future. Hence my positioning of adding some short exposure at this stage of the market cycle. So what do we have for the macro picture? We always look at the macro, and this week we had a number of macro situations that arose. Number one is that the big beautiful bill is probably going to get passed in some form or another, and that's going to be very, very bad for the deficit. We're going to have a $2 trillion deficit for sure. Okay, and that, although bad for the long term, is stimulative. So it's positive for the markets going forward. Big deficits are positive until they're not. And when they're not, it's going to be a devastating period for whatever generation is going to be left holding the bag is going to be bad. Okay, but now it's going to be good for the markets because it is stimulative. However, we have trillions of dollars, I think 7 trillion of debt that's going to mature in 2025. So that's going to keep rates high. Okay, and as you know me, the scenario that's going to kill this market is rates staying higher for longer. Okay, so, but in the meantime, the one positive macro is the big beautiful bill is positive. The debt issuance, the 7 trillion debt issuance, is negative. I'm talking about for markets. How that plays out, which one wins the positive or the negative for the markets, we have to see how that plays out going forward. Okay, but one thing is for certain: rates will stay higher for longer. Okay, this U.S. 10-year ripping higher. The rate at 4.35% is not good. Not good with not good in the long term. This is going to be a drag on the market. Okay. So what other macro did we get? We get both ISM numbers came out. The ISM manufacturing, which we look at, came in at 49 points, which is still contracting, but higher than 48.5. So I mean, manufacturing is still suffering. And the leading indicator of this manufacturing index, which is in itself a leading indicator of the economy, but the leading indicator are the new orders, and they came in at 46.4 versus 47, so they're contracting. So manufacturing looks to not be getting better in the future. However, the bigger thing is the bigger part of the U.S. economy, although manufacturing is important because it is goods, but we look at the ISM services as well, which came out this week, and it came out above 50.8, so it's back up to expansion from slight contraction in the previous month of May. Okay, so for June, we're back up above 50. ISM manufacturing doing okay. ISM services doing okay. ISM manufacturing not doing okay. Okay, and the big news and the other big macro news that came out is the non-farm payrolls, the jobs report. This is the ADP report came out, negative 33, that 1,000 jobs, private sector that came out, which is worrisome. But the non-farm payrolls figure came in at 147,000 for June, which is much higher than 110, which we were expecting. So market's happy. So the market is holding up jobs-wise. The market is holding up ISM services-wise. And, we have Trump's big, beautiful bill that is holding it up too. So far the macro is not falling apart. It's doing okay. So this is very supportive of the market. So We had technical picture bullish. Going forward, I expect summer doldrums. We have the macro that is supportive, nothing very devastating. However, because of this good news in the ADP report, in the non-farm payrolls, let's look at the FedWatch tool again. The FedWatch tool says what the Fed is going to probably do in terms of interest rate cuts going forward. Remember, we had 3 cuts for all of December 2025. What do we have now? 2 cuts. Before we had 3 cuts, 40%, and this was lower. Now, because of the good jobs, people are thinking that the Fed will not cut as much. They'll cut only 2 times in 2025, not 3 times as it was last week. So big difference. No rate cuts. Lower rate cuts means, as we had it before, interest rates, the US 10-year, higher for longer. I mean, people will argue that high interest rates are a sign that the economy is expanding and keeping inflation in check. Yes. But it's also what causes the eventual crash. Okay? Just keep that in the back. Like I said, I don't think it's going to happen this summer. Maybe later on. Who knows? Okay? So, in the last section of the weekly trading wrap-up, I usually like to talk about things that, caught my eye. But things that are surprising to me are the metals markets right now, because as we have markets going into high, we would expect commodities to go down. Are they? No. I'm looking at gold here, and gold is still maintaining the highs. Let's get rid of these moving averages. We don't need them anymore. Gold literally consolidating at highs, dropping the RSI down to nothing. Fuel for another move up. Okay? It's not falling with the market going up. It's not. A risk-off asset like gold should be going down when the market's going up. Not really. These shoulda, coulda scenarios almost never happen with gold. And the reason for that is because the fundamental reason for all this move in gold, after it broke up to 2,000 here, this entire move from 2024 is still active. Foreign central banks, namely China, still buying. Okay, so that's going to keep a bid under gold, regardless of what happens to the market. That's why I keep saying this is a perfect storm for gold. Okay, this is a very rare situation. Okay, you should be allocated to this space, in my view. The second thing is silver. Silver going up, breaking out the 35 and holding the highs. You shouldn't expect to see that. You should expect silver to go down during this economic expansion. Nope, it's going up. Something's telling you that we're having inflationary pressures here. And the last metal that we look at is copper. Copper came down this week, although it's still not breaking the all-time highs, but staying above the 487 level. Copper is over $5, guys. $5 a pound. That's huge. Okay? And it's staying high. List pattern, inverse head and shoulders, broke. And now it's trying to get higher than this 520 level. It needs to, in my opinion, break up above these levels before going much higher. So you have all the metals saying inflationary type pressures. Okay. You have the yields staying high. US 10-year, which means that we have to keep, the Fed is basically, the market is saying yields have to stay high because we still see inflation coming into the system. Okay, because the economy is doing well. So you have all these commodities going up, which signifies inflation. Oh, I forgot to mention the oil. Okay. Oil not going lower, maintaining these levels. It's not inflationary per se, but it's sort of an indecision level. Okay. It broke the downtrend, this high, but it hasn't really broken up past the $80 a barrel and $96 a barrel levels here, which means that it's in an indecision level. We don't know what's going to happen going forward, okay? If the economy goes up, this thing should not go up. Low oil is good for the economy, okay? That's what you want. You don't want it to go up. So at this point, with the oil move, after I lost on my short, I'm staying out of it. I don't know what's happening. I expect it to drift back down lower because this general downtrend hasn't changed and we're not in a war anymore. So that's why I expect it to go down, but I'm not taking a position. I'm flat on it yet. So we have a situation where we have the market going up, but the metals that we look at that should not be staying at highs or ripping are ripping, especially copper. That's surprising. And we have yields staying at high. So this is a very dangerous situation, okay? Not right away, but it's sowing the seeds of an eventual downward move that is more sustainable going forward, okay? However, I'm not going to think about that now because right now we're in full bullish mode. And even though I expect it to correct the market because we're very extended, I don't expect it to get far. Maybe 600. Will it cover this gap at 576? I don't know, but it's very possible considering how bullish we got and how far away we are from the moving averages. And look at this like relatively parabolic move going forward. So I expect a correction, but not too deep. I mean, even going down and covering this gap at 5.6, it's not that bad. We're into like a side of sideways choppy market. Okay? It will feel extremely bad, trust me. Okay, but a 5% move will bring it back down to what, 595, 600, 595 on the SPY. That's nothing, and that's just 5%, which is what I suspect might happen. I don't know, but I am prepared for it. I'm covered for it, so I'm all worries, as my Italian friends say. I'm all worries. So that's it for the shortened holiday, 4th of July holiday trading session. Let's see what happens next week, guys. Bye.